You know what's the one thing I never miss not being in LO anymore?
What?
Is that when we start a transaction, like 3 hours later, the real estate agent calls me up. When am I getting doxxed? When I retired early 2020, I was like, I will never have to listen to somebody tell me that ever again.
You talk about it privately, we talk about it publicly. This is the Real Estate Insiders Unfiltered Podcast. Welcome again to the Real Estate Insiders Unfiltered Podcast. I'm your host, Dwiggy.
What up, Dwigs?
What's up, Uncle Robinson?
I'm good. Man, we just had a conversation with Logan Mohtashami.
You're a little
analyst.
bit of a fanboy.
Dude, it's bad. Like, I love that dude. First of all, his hair game is fire. And then second of all, his brain is freaking out of control great.
His sweater made me think of the character from Avengers, the one with the iron arm. What's the name? I'll think of it in a minute.
Winter Soldier.
Winter Soldier. He's the Winter Soldier. That's his new nickname. So it's going to be. Sorry. Go ahead. Tell us what we're talking about.
Oh, man. Well, not only did we talk Marvel villains turned heroes, we also talked tariffs, volatility, CFPB changes, Fed cuts, deportation. Is he more optimistic about 2025 than he was on January 1st? And his number one leading indicator that he looks at to predict a recession and where that number is today. Man, we covered a lot of ground.
It was a lot.
Yeah, look, just sit back, relax, enjoy the ride, put it in your ears, kids. It's worth it.
Logan, welcome back to the show. We are excited to have you here. I am reminded of how badass that picture is over your right shoulder.
Yeah.
It's a good one, man. Right there. It's a good one. It's a good one. Hey, so nothing going on for us to talk about. Not a damn thing happening in the world.
Nope.
Keith and I are trying to get canceled this episode, so let's just dive straight in. Talk to us about tariffs.
What tariffs?
There's a few.
One of my favorite subjects. I brought my meme game out for this, and I
love it.
For those of you that remember Karate Kid, everyone Gen X baby boomers, we do a thing.
Sweep the leg.
Tear it off. Tariff on.
Oh, tariff off.
There we go.
So
I thought it was going to be sweep the leg. No.
After President Trump won, I talked about this in our podcast, how we're going to have to start to get used to kind of this tariff on and off process, because that's kind of what he did in his last presidency. But his last presidency, he didn't go into the trade war tap dance. That's what I call it until 2018, until after he got his corporate tax cuts in, because he kind of knows the markets will be disrupted by it. So as this has proceeded on, we just have these crazy headlines. One day it's like 200% tariffs here. The next day, it's taking off. The next day is going to do this product. No, now. So this is just how he has always operated, and we have to somewhat get used to it. So what's going on right now, it looks perfectly normal to me. But the one issue is that if you go into your kind of trade war tap dance early, you're going to have to pull the trigger at some point, or else the market's just going to think you're bluffing all the time.
Not that it's possible that someone hasn't heard you on a podcast, but just in case they haven't, explain the trade war tap dance for the uninitiated.
Well, I think when I think of a trade war, or if you're going to do tariffs, if somebody was serious about putting tariffs on other countries, and for it to be beneficial for the U.S., you just put tariffs on and that's it.
Right.
Negotiation. It's going to take so many years for this to kind of work itself out. We don't do that. We do this back and forth with tariffs. We're going to do this percentage. Oh, they're going to do a deal at this percentage, or it's about fentanyl. It's about jobs. It's about the trade deficit. There's all these things that, unless you track economics, it's very confusing. I totally get it. But to me, what Trump is doing is this is what he does. He tries to make deals, causes chaos in the marketplace. The marketplace tries to figure it out. And
is it oversimplifying to say that he's using tariffs for negotiation leverage on other things? And I think your point is, at some point, they're going to know you're bluffing unless you actually enact some tariffs along the road, right?
Yeah. I don't fundamentally believe that anyone in the White House really believes in like putting tariffs in and then letting it go, because it becomes a trade war. The other countries do it to you, and then it's back and forth, and then it doesn't become productive. What it does is what happened in 2018 and 19. Business investment went to zero. So back then, it was a much better backdrop to kind of try to do this. The growth rate of inflation was falling, rates were low, the economy wasn't in too bad of shape, but it just caused a lot of chaos. Now it's a little bit different because the Federal Reserve already raised its inflation expectations because of this. The public believes there's going to be like big inflation. I don't believe that's true. There's just a lot of things right now that it's just a different time of the economy to do this trade war without being disruptive. And we just see this week in and week out. But by April, we should get some resolution on this with the reciprocal tariffs that he's going to put on April 2nd. By the way, I just want to say thank you for the White House for moving that date from April 1st to April 2nd.
We got
because
a vacation,
I was thinking, oh my, it's going to be an
April Fool's.
And I was like, come on, this is now somebody's getting way too funny here.
I wasn't following you on that until you just said that.
Move it one day.
I was like, what would I miss? So, but consumer confidence came out today pretty negatively as well.
The University of Michigan confidence, if I took it at face value,
I love this rant.
It was the worst report I've ever seen in my life. It was like inflation expectations are skyrocketing, job confidence is falling, nobody's going to travel anymore. It was a disaster. But the University of Michigan Confidence Index is somewhat political, ideologically driven. It's like Democrats think inflation is about to take off. Republicans don't think it's going to go off too much. So there's a lot of noise, and that's just chaos, right?
Yeah.
The president is an agent of chaos, and this is what happens. So until you get some clarity, I totally could understand if you do not follow economics or any of this stuff is probably so confusing to the general public that it's just making people like freak out or not understanding what this all means.
So cut through the noise a little bit, and you can get specific or not. And I love that we're 0 questions in and we're already off script. That's what makes this podcast great. Like when you think about, and this actually might be on here somewhere, but when you think about the residential real estate resale market, the market that most of us serve. So not new homes, the human beings who wake up every day and are showing resale properties. Are you optimistic? Are you positive? Are you neutral? Or are you negative housing market for residential resale for 2025 with what you know today?
So oddly enough, the trade war tap dance is actually somewhat beneficial to housing, because what it does is it creates economic chaos, and already we're seeing people revise their growth estimates down. Which this whole year has been absolutely wonderful. The White House has this
for you.
I mean, but I mean, the White House has this entire mindset that they want lower mortgage rates. Right. They're flat out saying we want the 10-year yield lower. They don't care about the Fed funds rate. They want the 10-year yield lower. They want lower mortgage rates. Now, before we went into 2025, I was thinking the builders are the concern because their supply is rising, their profit margins are falling. When residential construction workers go into a recession or they start laying people off, the recession isn't that far off. That's good for rates going lower and existing home sales market picking up. With that, we have the government firing workers, right? Federal workers on there. So what that does is that lowers the total job growth level. If the labor force stays constant and grows, that means the unemployment rate could go up. Good for rates, right? The Federal Reserve kept that target at 4.3%. We're going to get there this year just based off of that. But then the trade war is creating stocks to fall down. Money goes into the bond market, growth estimates. And the White House Economic Council said on TV, we would like lower aggregate demand and raise the labor supply. All these things are actually beneficial for the existing home sales market. And we've seen it this year because as of this second, purchase application data is actually positive year to date.
Right.
We've had a few year-over-year growth prints where last year we were very negative on the week-to-week data. So because mortgage rates have fallen, a little bit more than 0.5%. It's helped demand. But if they take another leg lower, we're growing sales this year. Yeah. No equivocation.
Everyone's forecast will be off, right?
Yeah. It's just, if you could just head down towards 6% and just stay there, everyone's forecast will be off because
everybody's forecasts have been off the past.
Fair point. Yeah. But they'll be off to the good side this time.
Off to the good side. The trick is that when I look at the housing data the last few years, I've seen housing demand only really improve when mortgage rates go from 6.64% down towards 6%. And we just never been able to stay there at 6%.
I wanted you to touch on that because you often touch on duration, right? And so we had that one move down in August and September. The problem is that's right into the seasonality. That's sort of when the market's usually tailing off. So we got a bump there, but maybe this one feels very different because we're getting some tailwinds around rate going into the spring selling season. But talk about the duration, and then do you compare a difference to then and now?
So buying a house is not like buying something on Instagram. It takes time. So it's not like people, I've always hated this whole sideline home buyers. Like all of a sudden people just sit and then the mortgage rates fell 0.25%. They go, honey, let's just go buy a house. Let's just go, it's
today.
A process, right?
Yeah,
you kind of know going into the new year if you're going to be a buyer of a home. So the longer rates stay lower, the more confidence a potential home buyer or a seller that's going to be a home buyer because he's going to put the house on the market and then they sell and they buy another house. 70 to 80% of home sellers are buyers. So the longer the duration stays around 6%, the probability of higher sales grows higher and higher. It's just in the past few years, whenever we get there, demand picks up everything and everyone feels good, we just shoot right back up higher.
Yeah.
And then the demand fades out every single time. It has been a flawless correlation, but if you
does this feel different this time? Does it feel different this time?
It feels different in the sense that the White House wants lower rates,
and they're saying it into a microphone.
They're saying it into the microphone. The head of the FHFA now wants lower rates, and I'm trying to give him advice on what he can do directly within like a few weeks to do this. There are things that the White House and the Treasury can do that will be positive, where this was never discussed before.
Mm-hmm.
And again, if the labor data gets softer, the unemployment rate goes up, right? We're targeting people to fire them. Government jobs, if you take that out of the data pool, the total job growth slows down. You get toward a 4.3 or higher % unemployment rate, the 10-year yield will fall. Mortgage rates will get better. And I'm not talking about 3, 4, or 5%, but just heading down towards 6%.
Yeah.
That'll do the job. And if the labor market starts to really get weaker, then it just stays there for longer,
or goes even lower, right? Mm-hmm. And the real key, I think, the resistance point that we experienced last year is 6.5. It starts to get better, right? Around 6.5, it starts to get better.
Yeah, from 6.64 down towards 6% in the last 3 years. I've seen the housing data. When I exclude the seasonality out of it, that's when it actually gets better. And then we see it. It's like 12 to 14 weeks of positive purchase application data. And that filters to a couple 100,000 home sales. But imagine if the rates just stood there the entire year. And then everybody starts to go, okay, I'm ready to go now,
Yeah.
But in the past, it's always been rates. Let's go down there. Everyone's happy. Then boom, just shoots right back up higher.
What is your thoughts on this morning? I was reading about the White House is looking to open up federal land for more development. Obviously, they'll have the same hurdles potentially with environmental impact, et cetera. But is this between this conversation about rates and this like actual movement towards fixing the housing problem in this country?
Anytime you can add more supply, it's a positive. I don't know how big the velocity of federal land is. I mean, if it's got to be a livable area where people want to go and have jobs, so we have a lot of land, right? Yeah. But it's also in the middle of nowhere.
Right.
So, well, I mean, so was Vegas at one point.
So was Vegas, yeah.
No
so
offense.
The mob is what got that done, not the government.
It was Bugsy, right?
Yeah.
What was the guy's name?
Oh, Bugsy. Bugsy Siegel.
It was Bugsy Siegel that made Vegas happen. But in this case, that would take time, right? Mm-hmm. It's going to take a while, but to me, it's always this the simplest answer. Supply is the best way to deal with inflation. So anything you can do on the production side, I'm all for. But this is going to take like years to get the process stuff. But
supply side,
anything on supply, thumbs up for me.
Yeah, it just I mean, don't get me started. But the supply side solutions that everyone talks about, I agree with you, Logan. They will help, but it's years in the making. I mean, if they unlock the land tomorrow, they're not breaking ground for at least, I mean, years. You're measuring it in years, right?
The problem is when you're trying to break into federal land, you have to do all these, surveys and see if it works, and you know the people want to live there. It's not like there's a plot of land in Los Angeles
that the government owns.
Okay, there's a city, there's a Walmart, there's a Costco, there's McDonald's, there's things around
all
it that
the
people,
infrastructure.
Yeah, there is the general.
It'd be faster to convert some of the office buildings into condos and things in cities that they're trying to get rid of. That would make more. It is. Sense.
That's the only difficulty with that. And why it's been so small is that a lot of these buildings aren't coded for living.
Standard.
Sure.
And also it's very expensive to remodel them. I remember I spoke at an event in Los Angeles where this was the topic and everyone had to give like their best answer on what to do. And I said, just give me a bunch of dynamite. Let me blow these buildings up and I'll start from scratch. Yeah. And every real estate construction worker and planner in there was like applauding. They're like, yes. And everyone was very appalled by that statement. But I said, do that and then we can get things going. But
speaking the truth,
this is going to take forever.
Yeah, you'd be better off, I think, if you really want to bring more inventory to the marketplace to make it easier to condo convert for these resi buildings that have been probably overbuilt, and you're going to see downward pressure on rents in some markets. Usually, in the markets where you need more first-time homebuyer inventory, just rubber stamp, fast track the condo conversion process. So I'm a developer. I built a 200 unit rental project. Turns out rental demand has gone to crap since I started my project, but resale is still hanging out. Make it easy and inexpensive for me to condo convert, and now I can bring 200 units for sale. These would be new home construction in this example, but that's still 200 units that are actual addressable units that you don't really have to do anything other than change the classification from multifamily to condo. But
I'm going to bring up two subjects while we're talking about it. So we obviously covered, the tariffs. We've got recession. If it goes too far, could be a problem, obviously, right? Because, Keith and I talk about how housing's been in a recession for like 3 years, basically. Everybody else is just starting to feel some effects of that. I think this is a relevant conversation, and your thoughts on this. We're obviously, I said it from stage, don't really care what people think. I'm like, the climate's changing, people. I don't really give a shit what your politics are on why, but like there's rapid problems happening all over the US. And there was a study that just came out that I thought was really fascinating. 9% of homeowners today are paying more for insurance than they are their mortgage across the United States. To me, that's a big, like massive glaring problem. What are your thoughts just around this particular subject?
I'm actually going to be speaking for a charity event for the LA fires this week, and I hearken back to my interview on Yahoo Finance early 2024, and I just said there's just going to be parts of the U.S. that home buyers can't live. Yeah, and it's just there's a multiple stage issue here, and one of the reasons I've talked about this a little bit more this year. Florida wants to get rid of property taxes.
Yeah.
And I'm telling you, the only reason that's even being discussed is because of insurance costs.
Affordability.
And right? Florida lost migration. I mean, there was still migration there, but it was really slowed down. And homeowners are complaining a lot. Homeowners are also voters more than renters are. Okay, because if Florida does it, guess who's going to do it next? Texas is going to do it next. And Texas is already their homeowners.
They're high.
They're saying, where's my money going? Mm-hmm. You got homeowners now asking government, hey, what I'm paying all this for property taxes, where do I see the benefits? So Texas would do it. I even saw the Indiana governor talk about getting rid of taxes. all that does is kind of put a Band-Aid on the issue. Because if you cannot get insurance for a house, can't get a mortgage, right? If you cannot have insurance for a house, and there is a mortgage on it, there's get that off the books. But generally speaking, if insurance costs are just keep on rising like this all the time, and you live in an area that is prone to fire or hurricanes, do you really want to take your family there?
Right.
And live there where you're prone to this and you're paying the high costs or you can't get insurance? It is a terrible problem for those areas, and it's just going to get worse.
Yeah. I do want to add one piece to that, and I believe the stat is true, but context matters. So yes, I believe that 9% of U.S. homeowners are paying more for insurance than they are for their mortgage. I also believe most of those people are boomers. Most of those people have an incredibly low mortgage payment. Most of those people have their home nearly paid off or like they have massive amounts of equity. And so there's reasons why you're seeing upward pressure on that number. Yes, insurance costs as a component, but you also have a significant portion of homeowners who have a very low mortgage rate because of the boomer population and how long they've been sitting on residential.
I use this example. Somebody I knew, their home insurance doubled.
Yeah.
Like $1,400.
Yeah. James is raising his hand because his did.
Yeah. And a lot of people tell me, why won't these people foreclosure? I said, okay, so let's just take the math, $1,400 right. more a year. Okay. That is like 2 DoorDash meals for me.
Right.
Right. So you average it out.
Where the hell are you DoorDashing?
Do you foreclose on a house where you have a ton of equity in, or do you sell and go rent, or the disposable income from other things go down, but you keep the house, right? And that's just off of this. But if insurance keeps on rising more and more and more and more, then eventually it becomes an impossible thing. That's why I think at some point, it's not going to be this year, of course, the federal government, the state, and private sector has to figure something out.
On affordability,
we can handle this first wave of costs. It's not going to be, but if it's every year and going out for 20, 30, there's no way.
That's a follow-up I was going to ask you. Are you alluding to the fact when you say federal government and states, are you saying a national health insurance, national insurance plan for homeowners? So you're spreading risk?
Just for those, just for that thing.
For like a insurer of last resort.
Yeah. Insurance
that's federally mandated.
The federal government can do something like that if they wanted to. I mean, in a sense, FEMA somewhat to a degree, like the last, resort in that, but, it's a problem. I believe it's a real big problem internally for Florida, because if they're getting less migration and homeowners are grumpy, and you have a lot of elderly people there on fixed income, and then you have the condo market there where it's just, you can't sell. Yeah. I mean, there are people out there who literally cannot sell their condos because it doesn't, none of their HOAs, none of them qualifies for the mortgage. So it's a problem that we're in the early stages of it, but I kind of think 5, 10, 20 years out, if this is going one way, it's just going to get more expensive to the point where you are not going to be able to bank or do anything in those areas. And they'll be kind of dead cities in a sense. If you
can't enjoy New Orleans now while we can.
Yeah. But I mean, it's that kind of marketplace when you go out. Now, the first wave, people could somewhat handle it, but I just think that something has to happen, and getting rid of property taxes is just like a Band-Aid. For
sure.
Right?
Well, I mean, look, I think I'll say it slightly differently. We have a massive affordability problem in the U.S., and the insurance costs are only adding to that problem, and we need a solution. And I don't know exactly what that solution is. I've got a few I've proposed over the years, but
oh Jesus,
I'm not going to do it. 100-year mortgage. But we have to find a solution. I hope it's not massive downward pressure on real estate values. That's one solution, right? Is values just drop. But that creates a whole, we tried that in 08. It was not a pleasurable experience, right? So I agree with you. In the next, probably not even 5 years, I think we got like 2 to 3 years to really figure out how to solve for affordability. All right,
hey, Keith, can I do a follow-up?
Yeah, sure. Go ahead.
We got Logan, news. So I'm just
break it out.
No. This is interesting to have these discussions because I think Logan's willing to have them.
Yeah.
What is your thoughts on labor for new construction and some of these issues with deportations and stuff? You're welcome to answer or not. We haven't anybody who's willing to address it. So.
Yeah, he will.
I don't think it's as big a deal as people make it, just because I've looked at the data for like 20, 30 years, and we always get a high level of deportations. It actually, like, Obama deported more people than Trump, and Biden deported more people than Trump. But somehow the builders, if rates go lower and they, are rising permits, and they find people to build the homes. I think for projects like, people come in and say, listen, half my crew is out because they were worried about being deported. That can draw out a process. But to me, I've never seen the builders not being able to get the job done when rates go lower and demand picks up. So I'm not as, deportation freaked out as other people for construction, because they'll find ways to get it done. But we deport a large number of people every single year. And we do find ways to get things done on this. But I do think for projects, you already hear people saying, hey, listen,
you'll see delays.
20% of my crew is not here, half a percent, and all that. So I know a lot of Texas home builders are concerned about that. But every year we deport people, we find a way to get construction done on that. It does become, the builders are in a very tough spot right now because their supply has been rising. The South, which was their money, their golden egg for many years in building,
specifically Southeast, right?
The Southeast,
Southeast.
Texas, Florida, New Orleans, these areas where they were building so many homes. Those are the areas where inventory is increasing and the cost of housing is more. So they've pulled back on permits for about 18 months now. But now, on top of everything, if rates stay elevated, then tariffs come in, and then labor gets a little bit more expensive. This is not an environment where we're going to be building a lot of homes.
Yeah.
Because the builders are not the march of dimes. They're not here to lose money. And they've already got margin pressure going into 2025. And now they have other things to worry about. So
the builders,
not the best.
No, go ahead, Logan. I'm sorry. No, go ahead.
I just not the best environment. We saw the builders survey today. All the surveys their internally were negative. They were very energetic going into the year because they would get deregulations and lower costs and everything. And they assumed rates would go lower. Rates went higher, and now there's tariffs out there. So it's just a lot of stress for the builders, especially smaller builders. The big corporation, publicly traded builders have still enough profit margins to kind of have some little wiggle room, but it is somewhat more difficult for smaller builders.
Yeah. Builders are risk off, period. Right. They are risk off. There's too much volatility in the marketplace. And so they're just
if rates go down to 6%, just say their problem's somewhat solved.
Yeah,
right?
For them, right? They'll be risk on again.
It is one of the more frustrating things I see, that we are just so close to just getting something where, and we just can't get to that level yet, because I think for everyone, 65 to 75% of where mortgage rates in the 10-year could go is Fed policy, right? Yeah. And the Fed was heading toward that, and they've kind of paused back. But if you get 1% more of rate cuts into the system, it's much easier to get to 6% and even lower in that word. But it's this last 1% that's going to stall out. Mortgage spreads have improved this year. That's been a positive for the housing market. I am giving Bill Pulte as much advice as I possibly can to try to move the needle in terms of getting rates lower. But we're not that far away from getting a positive demand curve if we could just get down towards 6 and just
6.5
there.
Yeah, and stay there. All right, you brought up the Fed. I got a couple of Fed questions to take us through. One, you have taught me this, your focus on labor over inflation. I know you've been banging that drum for years, literally now. And then you also have a specific labor stat that you think is a great and very important leading indicator. So Fed talks inflation, but you're focused on labor. If you could explain why, and then specifically that, I believe it's construction labor that is the number that you like to focus on.
So back in 2022, Jerome Powell came on TV and he said, We would like the Fed funds rate to match 3, 6, 12-month core PCE inflation, the growth rate. And I was like, oh, wow, that is great news. That is like the best thing I could hear for housing, because the growth rate of inflation was about to fall, right? Global pandemics, they're very inflationary, and then the disinflation happens. Kind of like egg prices. Bird flu, prices shoot up, and then they shoot back down. And then toward the end of the year, they changed everything. They went into a very, very hawkish, we're going to keep the Fed funds rate elevated above inflation until something breaks. And I was like, oh my God, they switched. They went to the labor market. So a lot of people just thought, well, the growth rate of inflation is falling, we're going to get sub 6% mortgage rates. No.
Not so fast.
The Fed will feel better about sounding dovish and cutting rates a little bit more aggressively if the labor market breaks. And there's certain labor triggers that we've seen in every cycle post World War II. The Fed loves the job openings data. That's been getting better for them. Wage growth has been slowing down. They probably still want a little bit less wage growth. But residential construction workers have always been one of the best leading indicators of a recession. And this is why, we want the Fed to, if mortgage rates go down to 6%, it's not going to create massive inflation or anything. You're just going to build more homes, right? Supply is the best way to, defeat inflation. You're now getting to the point where you're too tight, where you're restricting the future production of homes that goes against your goals. So typically when residential construction, remodeling, apartment buildings, when they all start to fall, that's usually the code for, I call it the cheat code for going into a recession. So you have to be more mindful. If that occurs, of course, the 10-year yield goes down, mortgage rates go down with that, and then eventually demand picks up. But I'm just hoping that they could just get to that next level without creating a recession. It'll be more beneficial for everyone. But that's why I've always been a paper, rock, scissors, labor over inflation. So many people thought we'd already be under 6% mortgage rates now with the growth rate of inflation falling, but it was really the labor market.
And what are you seeing recently in these the construction numbers that you pay attention to?
So it's, in a sense, the last report was flat. The builder survey got worse. If rates stay anywhere in the 7.5, 7.25, they're going to start laying people off. Thankfully, rates came that first leg lower. We just need that next leg to go down. And this, I believe, one of the reasons why the government, White House, everybody wants the 10-year yield and mortgage rates go lower is internally in the White House surveys, lower mortgage rates is more important to the consumers than people think. And they feel that is to be a win-win, and you prevent residential construction workers going into a recession. You can build more homes. It's a total win for everyone. You just got to get that next leg lower out there, and then it'll be a positive for everyone. Be a positive for housing, be positive for the U.S., be positive for supply. Everything that we've looked at with economic cycles, the plus happens. We want it to happen before the recession starts.
One last Fed question, and I don't think you like answering this, which makes me want to ask you it. Because I'm a weirdo. Fed cuts. Most people, I think, were predicting 0 for this year. I've personally been on the record that I think there could be as many as 3. I'm curious what your thought. Like, will the Fed start cutting, and when? What do you think?
So before the year started, I had 2 plugged in. Mm-hmm. But how I look at all the data that we've seen after January, the unemployment rate's going to rise. Like there's no way around this. You can't fire federal workers and then withdraw money from the economy without, this is what they want, increasing the labor supply. If you increase the labor supply with, the civilian labor force growing, the unemployment rates will go up. Some people will think this is tactically done to get mortgage rates lower, because mortgage rates go down, demand picks up. It's government workers. White House doesn't care. They're use stats to say if we X the government workers out, the real economy is fine. But the Federal Reserve kept their target unemployment rate at 4.3%. It's like 4.1% right now. Yeah. Any kind of hit to the labor data at this point gets you there. And then that's code for, hey, listen, bond market, you could go lower now. We're not comfortable with this. This is the Fed's meeting this week, so we'll see what the Q&As are. But if that occurs, you can get 2 more extra rate cuts into the system. getting the Fed funds rate down to 3.5% just means that 6% level and even lower gets easier. That'll be a positive for the housing market, because when you have the fourth calendar year of the lowest home sales ever, adjusting to the workforce, it doesn't take much to move the needle. And like I've often said, this reminds me a lot of the early 1980s. Early 1980s, inventory was higher. There was a recession. Affordability was worse. Everybody says everyone's a renter. Nobody's going to buy a home. Mortgage rates fell 2.5% plus. It ended up falling 5% lower. We had a vertical increase in home sales. Like it just shot up in a period of time where people thought there's never going to be, because affordability was much worse back then than it is today. So lower rates solves a lot of issues right now. That we don't need to be this restrictive on this side of the ledger. And I'm hoping Pulte, FHFA, the Treasury, everybody, there's things that they can do to try to get mortgage rates just down towards 6%. And I think that's a positive for everyone, for the country, for production, for home sales to grow.
So you mentioned cuts to labor. It made me think of a question I wanted to ask. What are your thoughts on CFPB being dismantled for all intents and purposes?
I am,
you worried?
I've been such a big fan of qualified mortgage. It has been, to me, one of the reasons why we created this unbelievable middle class of homeowners in America that are really good in financials. We still need more clarity. Like, are the rules still in place? Because they left a lot of safeguards for states to enforce a lot of the CFPB rules. So in that sense, it's not like everything has gone away. But when you take something out, you need more clarity on, hey, is everything the same? They're just not going after anything new, because it's a disadvantage to the consumer. For businesses, they can have more wiggle room. But as long as qualified mortgage is in touch, I feel like the construct of housing is still there. That to me is one of the more important rules that have ever been passed in
is
US.
Is that just because it takes the friction out of the secondary mortgage market and just makes it more efficient?
When qualified mortgage came in, all of a sudden every majority of loan profiles looked excellent.
Just went that direction.
As soon as that happened, all the garbage stuff went away. Right. Yeah. And we just, the FICO scores were great. Cash flow's 30-year fixed. I mean, it changed everything.
Took a lot of risk out.
Yeah. So now, I mean, to me, it's still there, but states still have a lot of teeth left to kind of make sure that a lot of things the CFPB put in, it will still be checked.
Yep. All right. We always end on this question. I know you were a mortgage originator in the past. You've never been a residential real estate professional, but you get to be one today for this answer. If you were a real estate agent, what's the one thing you would implement today to help your business?
By the way, I just want to say, you know what's the one thing I never miss not being in LO anymore?
What
is that when we start a transaction, like 3 hours later, the real estate agent calls me up. When am I getting doxxed? And I was like, I thought to myself, when I retired early 2020, I was like, I will never have to listen to somebody tell me that ever again. And
that's Logan, the opening for the pod right there.
Well, let's add this part then, because now I just want to text you every few days asking you when my docs are going to be.
Yeah, that was just like, if you are a residential, this is how I explain like advantage of using data. The builders are selling more homes than the existing home sales market. The builders' home sales are at 2019 levels. The existing home sales market is record lows. This is like a huge difference. Yep. So what are the builders doing? They're offering lower rates, right? So you have people out there, right? There is $38 trillion of nested equity out there. It's like the most wealthiest form of capital that is sitting there. You can find clever ways to get buyers to come into your home. And it's like one of the things I've talked about the NAR lawsuit is that, I mean, I think most sellers are still paying the commissions, but people that weren't paying the buyer's commission, in a sense, their house was more expensive, right? Because you're forcing that buyer to bring more money into the equation.
Right.
Get knowledge with what the marketplace in your city is doing and how much nested equity your seller has, because you can be a little bit more clever with trying to sell those. Now, days on market is still very low. So we're still going to have near 5 million total home sales. It's not like home sales are crashing anymore. But you have an advantage with what the builders have taught everyone, that if you just offer credits for lower rates, man, that saves a lot of trouble. And also it goes into my God, if mortgage rates just got at 6%, demand picks up better. There are ways for you to do that out there. Yeah. So get a little bit more creative on the home selling process, because there's so much, $38 trillion of equity just sitting there.
And stop calling your loan officer
in a sense, but for a transaction, it can be.
Yeah. And then, as James just said, always call your loan officer within 3 days of acceptance of an offer, asking where docs are.
Yes.
That's the advice. I'll add one other thing, Logan. You're being too humble, which is not normally your MO. One of the things that I would recommend, you have a tracker that you offer that I'm a subscriber to. It isn't free, nor should it be, because it's amazing. Can you talk just a little bit about that? And we'll put a link in the show notes as well.
So every weekend, just for me not being humble, we believe we are the most prolific housing data people on planet Earth, and we are not shy about it at all.
Nor should you be.
Yeah. And we love challenging people, especially podcast stock traders, to debates all the times. But in this context, I thought, what is the best way to teach people like what's really going on in the housing market is every single weekend with our inventory, pricing, new listings data. We created a weekend tracker because our data is like months ahead of the NAR. So here we are live. What's the active inventory right now? These are the homes that are available for sale. What's the new listings data? The homes that come onto the market without a contract. What's the price cut percentages? Is pricing getting softer out there? Where is purchase application taking home demand out 30 to 90 days? Where's a 10-year yield doing? We put all these things in a tracker each weekend to give everyone kind of a 2 months heads up. So you don't have to wait for the existing home sales report to, this data's stale and old already. And this way, everyone is versed. And like for Altos, we could do it for every zip code in America and even make it more prolific and nerdy. But in general, if everybody just followed this for the last 14 years, you pretty much knew what was happening. And just kind of take all the noise away from everything else. And this is the most prolific data line to get, toward the end of 2022, when mortgage rates started to fall and the forward-looking demand got better. We're like, oh, that was it.
Here it comes.
There is no more. That the home sale crash has stopped. And it's going to take everyone 6 months to realize that their home price crash call is wrong. And they still won't understand why. Right. So the tracker is just designed to give everyone a heads up with multiple different data lines so you don't get lost. And this way, you can talk to your clients. You could talk to Uncle Dave. You could tell everybody like what's really going on, and you feel more confident. And you show them the data, and you're like, whoa, right? This is why the Nerd Tour is so popular, is when people see it, they're like, wow, I've never seen that data. Now I feel confident about talking about the housing market. And it just makes everything more efficient.
Yeah. And I will tell you, it gives you the best answer for when you go to the cookout, when people ask you, how's the market? You actually now can have a detailed data-driven response that will differentiate you from everyone else in residential real estate.
Yeah. And every event I talk to, I always tell people, Mike Simonson, my colleague, he does Altos Futures. He's the one that literally went to Lehman Brothers in 2007 and said, guys, this is way I track housing a little bit differently, and I see this trouble. And Lehman told him, we don't need you. I got 85 analysts. Mike walks down 20 yards, sees Goldman Sachs. Goldman Sachs takes the information. And they're like, oh boy, we'll take this. Goldman Sachs shorts the housing market, makes $10 billion. Lehman Brothers goes out of business. Right. And this is why we believe we are the most prolific daters, because we use live, fresh data. We don't care if it's positive or negative. It's just the truth, right?
Yeah.
We're not trying to sell anything. We're just trying to sell you the truth of what the data is. And it's a little bit more efficient than waiting for old, stale data to come in. And then, okay, well, that's great. That was like a few months ago. We want to look present and forward, not backwards.
Yeah, it's great.
Logan, at the gathering in June, I just want you to know Keith's going to be up front with a thing of popcorn like a fanboy, just watching you do your whole presentation.
I saw him not that long ago in Dallas. It was phenomenal.
The gathering should be even more fun. More tariffs. I'm gonna bring my Karate Kid outfit out, and just and I'm gonna bring Mr. Miyagi out, and we're gonna go over the tariff economics.
Let Keith hit it, man. He's got a mean left hook.
Yeah, and a good right cross. Logan, man, thank you for the time. We always love having you on. We'll have you on again in a few months to keep us updated on what's going on in the housing market.
It's always a lot of fun here.
Yeah, awesome. Appreciate you, brother.
Thanks, buddy.
Thank you.
Will subscribing to this podcast save the real estate industry as we know it? Yes, it absolutely will. Subscribe now and you'll be able to find out if I'm right.